Hi everyone. A very good evening on behalf of Union Mutual Fund. I am Anurag Sharma, and with me is Mr. Parijat Agrawal, who
Hi.
is our head of fixed income, and he'll be taking you through today's monetary policy. I would like to thank all our esteemed clients and partners who have joined in this for this MP code update. So, without taking much of the time, I would like to hand it over to Parijat to take it forward. Parijat, over to you.
Thank you, Anurag, and a warm welcome to all of you on this MPC update. So I'll share the PPT. Yeah. So today the MPC announced its policy measures, and what were they? So in today's policy, the repo rate remains unchanged at 6.5%. The standing deposit facility remains unchanged at 6.25%, and the marginal standing facility rate and bank rate remains unchanged at 6.75%. This was unanimous decision by the MPC members. All the six members voted in favor of keeping the rates unchanged. What was the stance? The MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Now, the decision on the stance was 5:1. Five members voted in favor of keeping the stance on withdrawal of accommodation. One member was not in favor. So the rates remains unchanged. The stance remains the same what it was in the previous policy. Now, what was the rationale behind keeping the rates unchanged, or why MPC members decided to stay on pause? The first and foremost is that the MPC has already hiked the rates by 250 basis points in the last 1 year, and the need was to assess the cumulative impact of the past monetary policy measures, because it takes time for the tight monetary policy or the rate hikes to work through its way in the economic system. So that they wanted to assess that how it is going forward. In the near term, the inflationary expectations, both in the domestic economy as well as in the global markets, have come down. They have moderated and are towards the moving towards the target. So this also gave enough room for the MPC to pause and wait for further data points to come in to take further measures. Now, what was the projection on growth and on the inflation, which gave enough confidence to the MPC to stay on pause? In the terms of the GDP data, the growth has remained resilient. So India's gross domestic product recorded a growth of 7.2% in 2022-2023. It was stronger than the earlier estimate of 7%. In fact, it surpassed the pre-pandemic level by 10.1%. Now, for this year, FY24, the projections by the RBI is the same. They have kept it at 6.5%. However, the numbers for the various quarters is slightly different. For the first quarter, they estimate it at 8%. For the second quarter at 6.5%. For the third quarter at 6%. And for the fourth quarter at 5.7%. So for the full year, the GDP estimate has been kept at 6.5%. Now, what are the factors which are supporting the growth, or what gave enough confidence to the MPC for these projections? The factors which are pointing towards resilient economy and the growth is one: urban demand remains resilient. It is visible in the high frequency data points like your passenger vehicle sales, air passenger traffic, the credit card, expenditure growth numbers, and so on and so forth. Similarly, the rural demand is on a revival path. This is also visible by the various high frequency data points, your three-wheeler sales or other uh, tractor sales and other factors. Similarly, there has been a rebound in the manufacturing activity. The May PMI, that is, Purchasing Managers Index, Manufacturing Index, which came at 58.7. This was a 31-month high. So generally, when it is higher than the 50, it means that the economy is expanding and growing. So this number gives a lot of confidence that the economy is on a growth path. The another factor which gives support to the growth is that improving household consumption and manufacturing investment activity. These numbers are showing a healthy growth. There has been a robust government capital expenditure. These numbers have been improving quarter over quarter. The consumer and business outlook surveys, which are done by the RBI on a regular basis, show continued optimism. So this is very important when the consumers display optimism in the economy. The external sector has remained resilient. We have seen higher net exports. Though the manufacturing exports have come down, it has been taken over by the service exports, which is a very healthy sign. At the same time, all these factors put together points towards a healthy momentum to a capex cycle going forward. So that's why, despite the global slowdown happening in the economy, the global economy is slowing down, but the domestic economy remains resilient, and it is expected to grow at 6.5% for the FY24. Now, what are the risks to all these expectations or all these numbers? First, there is a weak external demand because of the geopolitical situations that we have seen. The advanced economies, except the US, Europe, and other advanced economies, are showing a slowdown in their growth numbers. There has been a volatility in global financial markets. This can, bring down the growth. Protracted geopolitical tensions. If this kind of a geopolitical situation, what is happening in the between Ukraine and Russia continues for a longer period, it could impact the growth negatively. At the same time, the intensity of El Nino impact and monsoon disruptions could disrupt the growth projections. The growth projections could be lower from the 6.5% if these factors were to come into play and they become dominant. The most important factor which gave enough confidence or room for MPC to pause in this policy has been the moderating inflation. So for the full year, the projections by the MPC is at 5.1%. Last policy, they projected the inflation for the full year at 5.2%. So this time, the inflation has been projected marginally lower at 5.1%. The near-term inflation expectations are very, very benign. For the first quarter, it is expected to be around 4.6%, second quarter at 5.2%, third quarter at 5.4%, fourth quarter at 5.2%, and for the full year at 5.1%. Now, the factors which have started or helped in moderating the inflation are as follows. The April inflation came at 4.7%, which was the lowest since November 21. The major factor in this was food inflation, which declined to 4.2% in April. In fact, it has come towards the what is MPC's target of 4%. Now, the another important factor was that the survey of the households, the inflation expectation of households for 3 months to 1 year ahead have actually moderated by 60 to 70 basis points since September 22. So this also helps in anchoring the inflation expectations towards the target of 4%. The key points towards which has helped to moderate the inflation is first and foremost is the 250 basis point rate hike which the MPC undertook since last May. In fact, this has started to play through the economic cycle and has impacted the in or helped in moderating the inflation. In fact, in the last uh, uh, minutes of the RBI's annual report, it was mentioned that the 250 basis rate hike has helped the inflation to bring down the inflation by 90 basis point. So that's a substantial moderation in the inflation. At the same time, the supply side measures have eased. The various measures by the government has helped us the supply side measures to cool off. The global commodity prices have moderated. They have actually come down by almost 40 to 50% from their peak rates. So the input costs have actually come down, and that also the pressure on the corporates or the manufacturers to pass through the hike in input costs is no more there. So obviously that has helped in moderating the inflation. The near-term inflationary expectations are expected to remain benign, but obviously, yes, going forward in the second half, it is expected to be a challenge. It would remain around somewhere around 5%. Now, there are various risk points or risk, to these expectations. The first is obviously, the special and temporal distribution of monsoon. As we all know, a monsoon has been delayed. In fact, it just happened in touched Kerala coast today only. So obviously, it is going to be a very, very important factor in looking at the inflation data going forward, how it plays out. The El Nino impact, how severe it is, that is also would be visible only after 2 to 3 months. Supply side shocks have actually come down, but looking at the geopolitical situations, it can come back any point of time. This will be visible only, as the Ukraine and Russia, war continues to prolong for a very long period of time. Any global commodity price shock, what we keep looking at that. Recently, we saw that Saudi Arabia, talking about cutting down the, supply by 1 million barrels. So these kind of things may continue. And most important thing is that for inflation to come back to the 4% target, which the MPC has kept in as their objective before, actually to start cut rates, is of that the core inflation has to come down on a durable basis. It has come down, but the one thing which they are going to look at is that how the core inflation starts to moderate on a durable basis. Core inflation is, the headline inflation minus food and fuel. So food and fuel both have moderated. The core inflation, which is largely because of the of manufacturing and your service part, has moderated, but it needs to keep coming down on a durable basis. So that is a risk which, or that is one point where MPC is very, very focused upon. In terms of liquidity, which is very, very crucial to, make sure that the monetary policy actions actually seep through the economy. Liquidity has remained surplus. It was 1.7 lakh crore during April, May. It was lower than 2.9 lakh crores during full year of FY23. One important factor to note here is that there has been a skewed distribution of liquidity within the banking system. So some banks have surplus liquidity and some banks have, are running deficit. So what the RBI has been doing is that they have been doing both, injecting liquidity as well at the same time absorbing liquidity from the system. The system liquidity is expected to increase further as 2,000 rupee banknotes get deposited. Today in the press conference, the RBI governor highlighted that as of March 31st, The outstanding 2000 rupee note was to the tune of 3.62 lakh crore. And as of now, 1.8 lakh crore has come back into the banking system. And out of this, close to 80% has been deposited and 20% has been exchanged. So one can roughly calculate that at least 1.5 lakh crores is back into the banking system. So going forward, what the Reserve Bank has mentioned is that they are going to remain nimble in liquidity management while ensuring that adequate resources are available for the productive requirements of the economy. So they will continue to work on both the directions to absorb the liquidity and to infuse the liquidity so that it remains in a neutral zone, kind of a zone. In fact, in today's the press conference, the governor and deputy governor highlighted, the idea of liquidity management is such the liquidity would be so that the overnight rates should remain around 6.5%. Plus minus 5 to 10 basis, because that is where that their objective is. So from that perspective, we believe that liquidity would remain, slightly neutral to positive going forward. The another aspect of the managing this liquidity is that RBI will ensure orderly completion of government's market borrowing. The foreign exchange reserves stood at a comfortable level of 595.1 billion as of June 2nd. So liquidity is going to remain comfortable, and RBI would be nimble and manage on the both ends, infuse as well as absorb excess liquidity. If you look at this, the credit and deposit chart, weekly chart, the credit growth is at a multi-year highs on the back of spurt in activity as the economy heals, that we have seen in terms of the growth numbers and various high frequency data points, which I just talked about in my last slides. Another thing to note is that deposit growth has also increased. It has moved up. It is expected to move further. In this chart, the impact of 1.5 lakh crores, which has come back to the banking system, which will help the deposits to grow, is not visible in this chart because it has still not been factored in the RBI numbers. So they will maybe do it by the end of this month. So the gap between credit growth and deposit growth will further narrow. And as these two become, in tandem, because the high credit growth is expected to moderate slightly, that would be a good sign for the bond markets. Now, looking ahead, why we feel that the fixed income markets or the bond funds or any fixed income products look attractive at this juncture. First and foremost is that the real policy rate or the real policy, the rate continues to be positive, with the repo rate at 6.5% and projected inflation for this financial year at 5.1%. So the real rate is, a very healthy positive of closer to 1.5%. So that's very, very attractive for the fixed income markets. The moderating inflation provides headroom for cutting rates going forward. So that's what we believe would happen in the the last quarter of this financial year. The global central banks have put a pause on rate hikes or are on the last leg of the rate hike. Some central banks have done a turnaround by hiking one more rate hike, like Reserve Bank of Australia and the Central Bank of Canada. But this one can call is almost at the last leg of the rate hikes. Moderation in global commodity prices, which we have mentioned and seen, even the oil price has remained around at $75 a barrel for a long period of time. And in fact, we are buying a much cheaper oil from Russia. So input costs are coming down, and the pass-through has almost stopped, or there is no need for the manufacturers to pass through these high input cost. In fact, it has started to moderate. And in fact, in our own research, what we have seen that lot of FMCG companies or manufacturers have actually cut the prices and also improved upon their the volumes of that product. The RBI would ensure adequate liquidity for protective requirements, and forex position is comfortable. INR is expected to remain range bound. India's external debt ratios are low by international standards, and external sector remains resilient. So that gives lot of confidence that the rate cycle are expected to come down going forward. The absolute yield levels are very, very attractive. So 10-year that remains at around 10%. The AAA rated bonds are another 30 to 40 basis above that, around 730 to 750 range. So it remains very, very attractive. And as and when the RBI or the MPC starts to reduce rates, there are possibilities of mark-to-market gains to accrue as the rate starts to soften. So here you have two aspects. A, you have a higher accrual, and plus when the rates actually start to fall, one can get M2M gains. So put together, total holding period return would be very, very attractive, much better than your FD rates. However, geopolitical risk, global inflation trajectory, uncertainties around monsoon remain key risks, and markets are expected to remain volatile in the near term. So one important factor to notice here is that looking today's policy, one thing which has become clearer is that RBI is or the MPC is cautious. The near-term inflation expected to remain benign and moderate, but there are risks because of the the geopolitical situation or the monsoon and other factors. So RBI would like to see how the past monetary policy actions play out in the economy. So our belief is that there is no need for MPC to hurry up for the rate cut. They will wait for at least 2 quarters before taking a call on any rate cut, and they will depend on further data points to take actions. So it could be a prolonged pause, and any rate cut would be towards the end of this financial year, or maybe in the first quarter of the next financial year. So even though there is a rate pause, the absolute yield levels are very attractive. It remains at closer to 7% plus. And plus, if you hold your investments for more than a year, the possibility of M2M gains remains attractive. So total holding period return across the curve from the short end to the long end remains very attractive at this juncture. So my advice to all the investors is that stay invested. And if you want to invest as of today, it's a very, very attractive time or period to invest, but remain invested for a longer period of time to take benefits from all the action points which will happen in the fixed income market. So that's in a nutshell about the MPC update. Over to Saurabh.
Thanks, Faizad, and thank you everyone for being in the call. Faizad, there are a few questions I would like to take.
Yeah, please.
Can you stop sharing the screen, please?
Yeah.
Thanks, Faizad. So one of the question is that the entire most of the large economies, the outlook is not very positive. The Europe is going through a recession, and many of the country, and India is standing out. So, is it that we are giving this narrative as Indians, or will it actually can happen that while the world can go into recession and India will still shine through?
See, our view is based on data. It is not that, I just want to feel good. It is based on data points. So the data points are showing towards a resilient economy. So that is visible through our GDP numbers and various high frequency numbers, which are coming in of consumptions and the manufacturing capex cycle in terms of that. That is where it is showing. And at the same time, our inflation is also on a different trajectory compared to the the global economies like in the US or in the Europe, because a large part of our inflation comes from the food, which has actually started to moderate. In fact, some of the research which they do and see about that, how a cost of that veg thali or a non-veg thali has moderated. So this is research is done by some of the agencies that has actually shown that over the last 1 year, the cost has actually gone down by 9% because a lot of food prices have come down, global commodity prices have come down. So it is a healthy sign for India. Your growth is resilient, inflation is moderating. So these are the numbers which are speaking. So yes, we may stand out.
So can you also,
I'm very, very confident we'll stand out.
can you also add to this that because the way the Indian economy is structured is mostly consumption-led economy, and our percentage of the world trade in the overall economy is not very, very high. So the impact of recession happening in most of the country will not be that severe on the Indian economy. Is that a correct way to also look at this?
Yes, you can say that because we are a large economy of 140 billion people. Consumption plays a larger role. And plus, more than manufacturing, our service exports are actually holding on and they have increased quarter over quarter. So that gives us confidence that yes, we will continue to stand out.
Okay. The next question, Pajat, is that US is looking to borrow, raise money of $1 trillion through government bonds. And there's a fear that it will again spike the short-term rates in US. So if that happens, will there be any impact on the Indian debt market because of that?
See, already, because they are going to borrow. So it is not that when they are going to borrow, the rates go up. Fixed income markets runs ahead. This is how the markets. So the rates have already gone up in anticipation of this before the debt ceiling thing was happening. So they have already moved up closer to 5% or more than that in some cases. So what I understand is that yes, there would be pressure on for the shorter period, but at such a yield, where a large part of money is moving towards money market funds in US also, because the demand is also very high.
Okay.
So it would get absorbed. It's not that rates should continue to go up and up because there are no buyers. So there is a tipping point where there is still demand comes in. So at this rate of 5%, there is substantial demand. So in fact, the money market fund size has ballooned to almost $1 trillion in the US. Okay. So the money has moved out from the bank deposits and moved into money market. So they will continue to buy. And so from that perspective, I believe that a further spike is limited.
I think the question also wanted to, it's not very clear over there, but I think the question was also that can the foreign money can move out of debt market because the yields are moving up over there. Can that happen? And how significant is that portion in the entire market?
See, that has already happened. So now please try to understand that all the funds, normally they do allocation. They never put all their eggs in one basket in the US market. So they know that, the yields are very attractive here. We are closer to 7% and possibility of rate cuts are also there. So they look for total holding return. So some allocation would definitely remain in India. And looking at the attractiveness of our macroeconomic data points, money moves in. So that looks very attractive. So any money moving out looks, not, I would say that very, very, thin chance as of now at this juncture when my economic data points are looking good, because these are based on allocations, not on absolute numbers.
Thanks, Bhai. Amongst the long-term funds that we have, which is a GSEC fund, the medium duration corporate bond fund, and dynamic bond fund, if an investor who has a risk appetite for volatility, if he has to take a call, which one fund would you suggest where the gains can be maximum? Along with the risk, of course, the risk will be higher.
See, our gilt fund and dynamic bond fund, where we are running a very high duration of 5 years plus. Okay. They look very attractive from 1.5 year time horizon, a 2-year time horizon, because we have invested in a longer duration paper, and the accruals are high, upwards of 7%. And when M2M actually the rate starts to fall, as I mentioned, maybe in the last quarter or the first quarter of the next financial year, one can see M2M gains. So one can calculate the kind of M2M gains one would get. So total holding period returns would be very, very attractive. But yes, risks are there. In the interim period or the near term, it can remain volatile.
And that's fine. Like you said, the entire yield curve is very attractive right now from short term to long term. Are you looking at the short term to come down first and followed by long term, or both happening simultaneously?
See, obviously, the short term they will depend more upon the liquidity situation, and it would happen more closer to when we expect the rates to be cut.
Okay.
Because rates would not go down below 6.5.
Correct.
But my curve can become flatter.
Correct.
So that's where it is.
Okay.
So the longer term may start to fall much before actually the short term tends to move towards 6.5.
Okay. And on the corporate bond fund, what's the current yield on the portfolio or the month-end yield? You can look at that.
730. It's around 7.3%.
So even there, someone may get a risk, like spread compression with a lower volatility. If someone is looking at
yes. So see, I'll tell you what, we are running somewhere around between around 2.7 years duration.
Correct.
So compression plus rate cut, all this happening, one can add some M2M gains also there at 7.3 plus.
Okay. So there are some questions on equity. I'll take them.
Yeah.
So, yeah, there's one more question on fixed income side by Federal meeting next month and likely to have another rate hike of 25 bps. And RBI is not looking to hike anymore. They have gone for a pause. Will it impact the rupee dollar and rupee can depreciate from here?
See, as of today, I was just checking based on the future prices around the probability of the Fed on a pause is closer to around 65%. So, and 35% is saying that there could be one rate hike. So, even if looking at suppose they do for a rate hike, yes, there would be some pressure on the INR. But by looking at the past experiences, how the RBI has managed, the rupee may depreciate, but not substantially. It may by another 20. So today it's at around 82.5. It may go to 82.80 or something like that. But it would not be a substantial.
So also because the forex reserves are at pretty decent level.
Yes.
You can also intervene by not increasing the interest rate and going for the operation in the forex market, right?
Yes.
But the reserves are at a very healthy level right now.
That's true.
Okay. So the one question on US debt ceiling, is that behind us? Have they passed resolution, or is there still a chance of a default, or everything is sorted out?
No, it has been sorted out. It has been passed. Joe Biden has already signed. It has become a bill. So the debt ceiling has been suspended till Jan 2025.
Okay.
It has been suspended. So they are allowed to raise their bills and clear their bills and pay the interest. Everything is to be done as on a normal way.
Okay. So there's a question which I take: how to convert short-term FD investor into short-term debt fund, as 1 year FD is offering 6 to 7%. To be honest with you, you will need at least 2 years when you are looking at debt. 1 year, there's a chance you may be able to outperform FD, or you may not be able to. There's always a chance, right? But when you look at a 2+ year kind of situation, there's a huge probability that you will be able to outperform the fixed deposit rate because of the view on the market right now. Now, if some of the risk factors really blows up, right, and really changes the scene, but currently the way we are looking at it, there's a high probability of that happening in 2 years' time. So on a 2 year time, yes, you can. On a 1 year, it will be a chance. May or may not happen. Is that correct, Bhaia?
That's true. 1 year could remain volatile, and your returns could be the same as your FD rates, or even lower than that. But 2 year definitely, yes, you would have a better return.
Okay. The next question is on the equity market valuation. So as per our fair value update, the equity markets are not very, very expensive like they were in 21. They are single-digit premium. Normally, Indian markets are trading at a premium. Very rarely they trade at discount because India is a growing economy. So from the equity side, we think also apart from debt, equity also for the 5-year horizon, it's a good time to be in the market. Don't be out of the market. You can get into via STP mode for 3 to 6 months. The valuations are not very expensive. There's another question on small and mid cap for next 2 years. I would not recommend any equity product for 2 to 3 years because things can get volatile. Equity markets returns are not linear. They can be erratic in the first 2 years and extraordinary in third and fourth year. So you really don't know whether in 2 years you will make money in equity market or not. But if you are investing for 5 years, surely at this level you will be able to make money.
Can I add something, Saurabh, here? See,
please.
Just hold. I was just explaining about how our GDP numbers are coming out or how our high frequency numbers are looking at it. And we were talking about India standing out. So all these data points are showing towards that robust, durable growth. So obviously, yes, it makes sense for anyone to come in equity.
But remember, time is the most important thing. If you come for a shorter period, your experience can be volatile, even in debt and equity both. So when you're selling debt right now, long term, look at minimum 2 years, and your client, high probability that your client will not have a bad experience. Right? And for equity, you should look at least 5 years. And there's a good probability the way GDP, like Paja said, the way GDP projections are coming in, that markets are looking to be at a very good level currently. Okay, that is all. Thank you everyone for joining in the call. And just to sum it up, we think it's a fantastic time to be in the bond market and also equity market. Time horizons are different. If you're looking at long-term debt and the client has appetite for volatility, G-Secs are the way to get into the market for next 2 years minimum. And you should be able to outperform the traditional fixed income rates. If you're looking at longer tenure, yes, equity, also the valuations are not expensive. While there may be a lot of noise in the short term, but the way things are looking in 2 and 5 years for debt and equity are extremely good. Anything else, Pai, you want to add before we close the call?
Keep investing.
Yes, there's a good time to be in the market.
Yes, keep investing and stay invested.
Okay, thank you everyone for joining in.
Thank you. Thank you.
Thank you.
Thanks.